Hello, and thank you for joining us for this World Council of Credit Unions virtual global financial symposium preparing credit unions for 2022. My name is Greg Newman, Director of Communications for World Council. The economic impacts of COVID-19 are still being felt throughout the world. Some of our regions are facing deeper and longer lasting negative effects than others. Along with the impacts that are being felt on a national and regional level, credit unions are facing their own unique set of financial challenges going forward. This event is designed to help credit unions prepare for the long-lasting impacts of the pandemic, as well as a post-COVID future. We'll examine global economic forecasts for the year ahead and provide specific indicators credit unions should be looking at as they prepare for 2022. And this virtual event is going to feature presentations today from Franziska Ohnsorge, Manager of the Prospects Group in the Equitable Growth Finance and Institutions Practice Group at the World Bank, and Dawit Kebede, Senior Economist at Credit Union National Association, or CUNA, World Council's largest direct member organization based here in the United States. We are providing Spanish interpretation services for today's webinar. You can select that option by clicking on the interpreter button at the bottom of your screen. Tómese un momento para hacer clic en interpretación y elija su idioma, inglés o español. If you have any questions for our speakers, please use the Q&A button at the bottom of your screen and type them in there. I'm going to be asking them as time allows at the end of both presentations, but we do want to get to as many of them as we can today. And just one more housekeeping note, today's webinar is going to be recorded and it will be available later today on the World Council YouTube channel. That's at youtube.com/woku. We are going to start today with a presentation from Franziska Ohnsorge. She is the manager of the Prospects Group in the World Bank. Prior to joining the World Bank, Ms. Ohnsorge worked at the International Monetary Fund and in the Office of the Chief Economist of the European Bank for Reconstruction and Development. She has published on a range of topics in policy and academic publications, and she earned a PhD in economics from the University of Toronto. We are thrilled to have her with us today to provide a high-level view of what to expect from the global economy over the next year. And Franziska, I incorrectly said World Council, but we'd be happy to have you here as well. But thanks for being here, and I'll turn it over to you now.
Thank you, Greg. Okay, so good morning. It's a pleasure to be here this morning with you, with Greg, and with David to talk about the global outlook, with a special focus on our client countries, as well as probably yours. Those are especially the countries that we call emerging markets and developing economies. So the global economy remains strong, and it remains in a strong but uneven recovery, with some signs that was even stronger than we had expected over the first half of 2021, and possibly more uneven than we had expected in the second half of 2021. So in the next 15 minutes, I structure my remarks around three questions. First, what's the global outlook for the global economy and emerging markets, developing economies in particular? Second, what are the risks to this global outlook? And third, what are the particular challenges posed by inflation? So let me start with the environment that emerging markets and developing economies are currently facing. They are seeing a rebound, strong rebound in manufacturing and services activity from a very deep recession last year. They see a goods trade rebound that's been so fast that shipping couldn't keep pace, and news stories abound of ports being unable to process the container ships fast enough. And they're seeing slightly higher borrowing costs, but those are still benign by historical standards. So the incoming data point to a very solid rebound, although one that is now moderating a little bit just recently in the last few months, as expected. And these developments are the reflection of the strongest global bounce back from any global recession in over 80 years. The chart on the left here shows you how global GDP evolved around past global recessions. You can see them listed here on the x-axis of the charts on the right. So the shadow in the chart on the left shows you how output evolved around past recessions. The blue line shows you the current rebound in global GDP. You can see it's much faster than in any of the global recessions that in a lifetime. This is a once in a lifetime type of global rebound. That said, this rebound is also unusually uneven across advanced economies and emerging market economies. And we try to show you this in the chart in the center and on the right. It'll give you a glimpse, and we can get back to that later. In 2022, in the chart in the center here, you see that almost all advanced economies will have regained their pre-pandemic level of per capita outcome. But as you can see in the chart on the right here, not even half of emerging markets and developing economies will have expected their pre-pandemic output levels, per capita income levels. And that is in contrast to previous recoveries from previous global recessions, when typically a majority of advanced economies and EMDEs rebounded relatively quickly. So this is the historical context. Let you skip this one. We're happy to get back to it if you're interested later. Let me give you some flavor of the outlook for EMDE growth prospects. Now, numbers are numbers, so let me try and put them a bit into context for you so the numbers achieve some meaning. Bear in mind that the World Bank does not publish a full set of growth forecasts for the global economy until the first week of January 22nd. But individual regional and country offices of the World Bank do publish growth forecasts for World Bank client countries, EMDEs, in their regions. That is happening over the course of October. So unfortunately, not all of them have been published yet. So I can't show you a consistent overview yet of the latest forecast. But what I can show you here are our official June forecast. And I can give you a pointer where we think the surprises are happening compared to our June forecast. So to start with, the forecasts are for a robust growth rebound in 2021 in all EMDE regions, after last year's first EMDE output contraction in 7 decades. And in most regions, the rebound will fade. This year's rebound will fade next year, as you would expect. No? It's just a strong rebound. Broadly speaking, the global economy still seems to be on track for these June forecasts. But there seems to be some rotation from advanced economy growth to emerging market and developing economy growth. And there were some upside surprises in the first half of 2021 and emerging headwinds in the second half of 2021. So for 2021, largely as a result of past data releases, not better forecasts for the future, past data releases, growth prospects for almost all emerging market and developing economy regions other than East Asia now look a bit better than what we show here. That's for 2021. East Asia and Pacific is an exception to this pattern because several countries have reimposed lockdowns again. Now for 2022, the heavily commodity reliant regions of Sub-Saharan Africa and Middle East and North Africa are likely to do a bit better than we expected in June because of the recent run-up in commodity prices. In Europe and Central Asia, as well as in Latin America and the Caribbean, which are also both heavily commodity reliant, policy tightening will offset some of the growth benefits of high commodity prices. And the outlook for 2022 may be a bit weaker than what we had thought in June. Now, COVID-19 outbreaks have been one factor, but not at all the only one in the changes in our growth prospects since our last full set of official projections in June. You can see here that in 2021, the outlook improved a bit more in advanced economies with faster vaccination rates, here the blue ones, than in EMDEs and low-income countries with slower, below median vaccination rates. In sum, the outlook is very good for this year and next, even if emerging markets and developing economies are lagging advanced economies, and even if there is now some slowdown in global activity underway. But there are considerable risks around this outlook. Now, first, there is the ever-present risk that yet another COVID-19 variant will be so virulent that it derails the global recovery, even if economic activity appears to be increasingly decoupling now from the pandemic. Second, and we return to this in our last question, the persistent rise in inflation may eventually force central banks to tighten before the recovery is complete. Third, financial vulnerabilities have intensified sharply since the pandemic, and I'll show you in a minute. And that makes some of these countries' financial systems vulnerable to stress in the event of a sudden increase in borrowing costs. And again, we'll return to this in a minute. And then there are the effects, the risks that affect some country groups disproportionately. There's climate change, there's geopolitical tensions, there's food insecurity, and there is conflict. So among these risks to global growth that I just showed you, perhaps the most urgent one is the possibility of financial market stress. In that pandemic-induced global recession of 2020, debt of all kinds surged, as you can see here in the left chart. Government debt rose by 9 percentage points of GDP to 61% of GDP in 2020. This is the fastest one-year increase in the past 3 decades. That's government debt. Contingent government liabilities in the form of private sector debt have also risen, not least because of loan guarantees to corporates by government. These are support programs put in place by governments. And it's not just the debt increase in the last year that was large. This recent debt increase has come on the heels of a decade of rising debt in emerging markets and developing economies. And you're probably more familiar with this than I am. Bond issuance this year was even larger than it was in 2020 and in 2021 in emerging markets, 2019, in emerging markets and developing economies. That's backward looking. Now, going forward, there are expectations that global government debt at least will stabilize, or it might even decline as the economic recovery gains momentum. That's possible, but it would be historically unusual. And that's what I want to show you in the chart on the right. In the chart on the right, we have taken global government debt and show you how it evolved around all the past global recessions since 1970. So T is the year of the recession always. And you can see that in past global recessions, at least, government debt did not stabilize. And certainly it didn't decline. That shadow is going up. After previous global recessions in the past 5 decades, global government debt rose by a cumulative 4 to 15 percentage points in the 5 years following these episodes. And that increase was particularly pronounced for advanced economies, but you also saw it in emerging markets and developing economies other than China, especially after in the 70s and 1980s global recessions, when a lot of them slid into debt crisis. But who knows, maybe this time will be different. Another growing risk that we read about in the news all the time now is that inflationary pressures trigger a tightening of monetary policy. And one reason for inflationary pressures are commodity prices. And recently we've also read a lot about commodity price volatility. So energy prices especially have soared in the last few months. And even non-energy commodity prices have stabilized now, but at historically high levels. Natural gas and coal prices have more than doubled since the start of the year. Oil prices hit a 7-year high a couple of days ago. And this is no longer contained in energy markets. These sharp increases in energy prices are now affecting other commodities. Fertilizer plants in Europe have closed because natural gas is the main input into fertilizer production. So we know that that will translate into higher food prices next year for the next harvest. China has limited production of aluminum because it's very electricity intensive, and steel, which requires a lot of coal, and coal prices have risen. That has driven up the price of aluminum. And the price differential between natural gas and coal compared to crude oil is now so large that crude oil is beginning to be considered as a replacement for heating and electricity generation. That would further drive up oil prices. So high energy prices are increasing inflation pressures. In addition, food prices are also driving up inflation pressures. Since the third quarter of last year, most agricultural prices have increased sharply, and some have now reached levels we haven't seen since the 2011 price spike. Now, these price pressures increase the risks that a large number of central banks is forced to tighten policy, and that would hold back the recovery before it's fully complete. So let's look at inflation in a bit more detail. At 5.1%, inflation in emerging markets and developing is now at its highest in a decade. And the inflation increase has been broad-based. We've seen it in 4/5 of countries. We've seen it in food inflation, core inflation, energy inflation in those EMDES for which we have data. Some have argued that this is base effect because of low inflation last year. And there's some truth to that. But again, the decline in inflation last year was unusually mild for any global recession in the last 5 decades. And the inflation rebound since last year's global recession has been unusually quick and strong. Now, we estimate that the global inflation pickup since the depths of the global recession last year, April, May 2020, has predominantly reflected a rebound in global demand more than supply disruption per se. That would suggest that the news stories that we're seeing about shipping backlogs, etc., may be a reflection of strong demand pressures pushing against supply bottlenecks rather than actual supply disruptions. And it suggests that inflation pressures and these supply bottlenecks will ease as global growth eases next year in line with our forecast. So based on our model and our growth and oil price forecast, we've estimated that global inflation this year in 2021 might rise by somewhere between 1 and 1.5 percentage points. And consensus forecasts are broadly consistent with this. And the global inflation thus far also seems broadly on track for that. Now, that kind of inflation increase would lift inflation above target in about 1/2 of inflation targeting emerging markets and developing economies. That's manageable if it's transitory. But the real question is whether this short-term inflation increase will de-anchor medium-term inflation expectations. So for now, inflation expectations in emerging markets, developing economies have been broadly stable. But in Europe and Central Asia, Latin America and the Caribbean and South Asia, they have already inched up a little bit by about 1/4 percentage point, as you can see here in the chart on the right. And 1/3 of our emerging market sample of the central banks with data have already determined that it's better to tighten policy now than to wait and see whether inflation increases are temporary. Russia, Brazil, Peru, Mexico, for example, have all tightened monetary policy over the past several months, in part to address concerns that the inflation increase may not be temporary. And that has added to borrowing costs in emerging markets and developing economies, as you can see here in the chart on the left. Although they do remain, policy rates do remain below the long-term average for now. It's a gentle, steady tightening. And that's one reason why growth in many emerging markets and developing economies is probably going to disappoint compared to our June forecast in 2021. It takes a while for monetary policy to gain traction. So that's all about concerns about domestic monetary conditions in emerging markets and developing economies. But there is an additional risk from rising inflation. In addition, emerging markets and developing economies face the risk of spillovers from inflation surprises in the United States. And as you see, as you saw on the previous slide, high debt makes them ill-prepared for financial market stress. In advanced economies, rising inflation has caused financial markets to revise up their expectations for monetary tightening, as you see here in the chart on the right panel. Up until just a few weeks ago, the Federal Reserve was signaling its first rate hike for the second half of 2023. Now, in the latest medium projection, the possibility of liftoff has been brought forward by a full year to the second half of 2022. But from an EMDE perspective, monetary tightening in the US doesn't have to materialize. Even just investor concerns about the possibility of higher US inflation monetary tightening are a risk for emerging markets and developing economies, because they could cause financial market jitters. And those will come with higher borrowing costs. Refinancing these record high EMD debt levels that are now the highest since 1987 would become more expensive long before the recovery is fully entrenched in emerging markets and developing economies. And emerging markets and developing economies, financial market jitters also tend to come with depreciation pressures. And in more than a dozen emerging market and developing economies, more than half of government debt is denominated in foreign currency. These countries are especially at risk of debt distress should one of the financial market risks materialize. So to close, yes, we're in a robust recovery, although emerging markets and developing economies are lagging behind the advanced economies. But this recovery is subject to a number of risks. In particular, the combination of record high debt, and rapidly rising inflation increases the risk of financial market stress. Allow me to point you to a few studies we've recently released where these points are further substantiated. So we've recently published several studies on high debt. That is the aftermath of debt surges by Ken Rogoff and Carmen Reinhardt. Then a mountain of debt that looks at debt booms that are currently underway and are put in a historic context. We've also looked at the drivers and prospects for inflation for this year and next. And again, you can find all of them on our website under this link. On this website, you can also sign up for our monthly newsletter on global economic developments. And you'll find our updated full global growth forecasts in the first week of January. And with this, I very much look forward to the discussion and to David's discussion.
Franziska, thank you so much. By the way, I always credit people who pitch their items at the end of any presentation. So I do want to ask you if you want to come back on camera here for a second. I look at your presentation and the words that come into my mind are cautiously optimistic, maybe with an emphasis on cautious. Is that a safe way to say?
The emphasis on cautious, yes.
All right, and we will have Franziska available after our next presentation. If you do have questions, again, please use the Q&A button at the bottom of your screen. You can write them in there, and we'll be asking them at the end of our presentations. We're going to shift now to a more credit union specific look at the year ahead with Dawit Kabeda. Yeah, Dawit has 8 years of research experience in the academic world, along with both not-for-profit organizations and private industry. His previous research areas cover topics on trade, employment, consumer finance, and policy evaluation using statistics and economic models. Dawit worked for CUNA Mutual Group as the primary analyst for the Investor Guidance Center and Consumer Sales Channel of the TrueStage insurance business before joining CUNA. He earned a PhD from the University of Wisconsin-Madison, and his major was in development economics. Dawit, you're going to focus a little bit more on the credit union space, specifically here in the United States, but I think we can probably take a lot of parallels away from that to other regions as well. The floor is yours.
Thank you, Greg. And I would like to start by saying good morning to those of you who are in the Western Hemisphere, or good afternoon if you are on the opposite side of the world. Great, are you able to see my presentation? Okay, so as Greg mentioned, I will be talking about the US credit union outlook, mainly focusing on how credit unions performed during the pandemic and what our expectation is for 2022. And I would like to start by this graph. This graph shows you the relationship between US economic growth and credit union loan growth. As you all know, loan growth is impacted by a lot of factors, but I would like to bring your attention to these 4 different data points that are shown by the circle, where we experience an economic downturn, and it shows you how credit union loan growth performed during these periods. As you all know, there is a good correlation with that economic downturn and loan growth. When economic growth is really going down, we know obviously demand for credit declines because aggregate demand will decline. And in some cases, like in the previous recession, there is also a supply shortage of credit, especially if there is a financial crisis linked to that. So what you can see here is like in the 80s recession, 90s, and the Great Recession of the 2007 and 2009, when the economic growth becomes negative, the credit union loan growth also dipped into negative territory. But in 2020, we were officially in recession for 2 months of 2020, but we didn't see loan growth dip into negative territory during this period. Why is that? And as you can see, like in 2021, although that 2021 loan growth rate is the year-to-date loan growth rate, which is not annualized, and our economic level has rebounded. Actually, US economic growth based on second and third quarter data from the Bureau of Economic Analysis shows that we not only achieve pre-pandemic levels of economic output, we have already exceeded it. So the key important question is, what keeps that loan growth rate from falling to negative territory, just like the previous periods? In this slide, I will show you the loan growth by product for credit unions. As you can see, for some product types, the loan growth has actually indeed went into that negative territory. Mainly, this is loan growth for new auto loans, credit card loans, and second mortgage and home equity loans. However, on the other hand, there was a boom in the refi market because of lower interest rates for first mortgages. And there is also an increase in commercial loans, mainly driven by the payment protection program, which was part of the stimulus package provided by the government. We've also seen increases in used car loan growth rate. So some of the increase in used car loan growth rate is also linked to the supply chain shortage and lack of new cars available at dealerships. But coming into 2021, you can see that even those products that we were experiencing negative loan growth rate are trending upwards. Based on the year-to-date data for new car loans, for example, for credit cards, it's really inching up from below 5% negative to like close to zero. It's really going up. And we're also experiencing a slight increase in second mortgages. So as you can see here, the refi boom for mortgage looks like it's slowing down year to date so far. That's mainly driven by increased prices of homes, but still at a very high level. So what do we expect going forward? So what happened in the first half of the year is, because of vaccination expansions and consumer confidence coming back, we started really consumer spending going up. And with that, we have seen loan membership also go up. And because of that, we believe that these loan growth will continue, even though the momentum looks like declining because of the Delta variant, which, by the way, is actually reached at peak level right now in the US. We believe the loan growth for credit unions will reach 6% by the end of this year, and in 2022 will go up to 9%, which is the same as the average for the last 5 years. And when we see membership as well, we've seen a tepid growth in membership during the pandemic, but that also started to go up post-pandemic, especially year-to-date numbers show that. And we believe this will continue to grow. And by the end of 2022, we expect membership to grow by 4%, because if history is a good indicator, usually credit union memberships grow faster after economic crisis wins. Another interesting trend is in the saving growth. In 2020, we have seen a very record high savings, which is 20.8% growth for 2020. That's really high. As you can see, if you go back as far back as 1995, that's the highest growth that we have seen. So this is driven by a lot of factors. At the beginning, because people were uncertain, so consumer spending is very low. So people will tend to save more instead of to spend. And another thing is, there were 2 federal stimulus payments that goes directly to householders in 2020. That also contributed to that huge increase in savings growth. Come to 2021, what we saw in the first 2 quarters is, again, with the economic recovery and with spending going up again, we see savings go down in the first 2 quarters. And other result of that, we believe this would continue. And by the end of 2021, saving growth year over year will be at 12%. And because we don't expect any more assistance from the government in the form of direct payments because of the stimulus. So that's our expectation. And by 2022, the saving rate will go down to 6%. So another important point that I would like to bring to your attention is the relationship between delinquency, loan delinquency, and economic crisis. So this graph shows you to the US unemployment rate and credit union delinquency. So what happens when when millions of people are losing their jobs? At the beginning of the pandemic, in March and April, the US lost 21 million jobs in 2 months. There has been a steady increase since then, and we are really making a lot of progress in that. However, going into the pandemic, what credit unions expected was a similar thing that happened in the past. when people lose their employment, that's reduced income, and they will not be able to make payments for their loans. And as a result, they will not, the loans will be delinquent. And you can see here, like during the Great Recession, unemployment rate was like 10%, but delinquency rate was about 16%. And that also holds like in the 80s, also in the recession of 2001, that brief recession. But come to 2020, you can see actually like the delinquency rate is trending below the unemployment rate. That's totally unexpected, because going in, credit unions expected, they have increased their loss provisions to accommodate for non-performing loans, but that didn't happen. So what happened instead? In 2020, the loan delinquency rate was 59 basis points. That's the lowest, as you can see in this graph, since 2007. Why? Obviously, the government support in the form of fiscal stimulus that goes direct in the form of direct payment to households, and also different regulations like forbearance have played a role in this. If people are not able to make mortgages because they are unemployed, they were able to work with their credit union or with any other financial institution to get forbearance on those loans. It's the same as student loans or any other type of loan. So that actually played a role in bringing the loan delinquency at its lowest level. And this trend has continued in 2021. We are also seeing in the first quarter, like 44, 45 basis points. But we believe by the end of 2021, the loan delinquency rate might go up slightly. Why? Because most of the factors that contributed to this lower level of delinquency have ended. So there is no more government assistance from the government in the form of direct payment, and most of the forbearance programs have already ended. And as a result, we think that will go up slightly. But still, since the economy is recovering, employment numbers are going up, we believe people would still be able to make payments. And then the loan delinquency going into the end of the year, and even in 2022, will still be lower than the long run average. The same thing goes for net charge-offs. In 2020, the net charge-offs was 44 basis points, again, the lowest point like in the last 13 years. And in the first 2 quarters of 2021, the loan delinquency is actually for credit unions at the lowest level that any of our team members have ever seen in their careers. And believe me, like most of them have been here like more than 3 decades here. So that's a really like very impressive. Again, because of the same reason that we expect the delinquency rate to change in 2022, we also believe the net charge-off will also go up a little bit by 2022, but still it's not going to be very high compared to previous last 5-year average, for example. Return on asset, or the earnings for credit unions, is also one of the very interesting performance metrics that we have seen like very interesting results, especially in 2021. The first 2 quarters we have seen return on assets going above 1% consecutively for the 2 quarters. And again, this is mainly more, especially like the gains that we see in these quarters are mainly caused by, because I told you earlier that when credit unions were going into the recession, they expected high delinquency rates, high non-performing loans. So what they did is they increased their loss provision allowance. And when they see that a lot of people are really making on-time payments, and then the delinquency and the charges are not going up anywhere, they started reducing that loss provision. And as a result, that actually boosted their earnings. Actually, most of the earnings that we see in 2021 is directly related to the reduction of this loss provision from 50 basis points down to 7 basis points. But another important factor that I would like to bring your attention is most of this increase in return on assets is driven by big credit unions with assets over $1 billion. You see on the right side of this graph, assets, as credit unions with assets over $1 billion have 126 basis points in earnings compared to 87 points for the next largest asset group. And the story is, it goes down for the different credit unions by asset size. So the distribution is not even. And also some of the factors that also contributed to this, like the PP loans, sale of mortgages would probably cool off compared to what we saw previously. And as a result, we may see credit union earnings slightly go down going forward in 2022. But again, because of the performance we have seen the first half of the year, in 2021, credit unions will finish off the year registering 95 basis points for return on assets. So what else is happening? So what should we look forward? So these are like the key performance indicators for our credit unions. But what should we expect going forward? In this table, I'll show you the index of consumer sentiment that is published by the University of Michigan. This is a very important indicator because it gauges consumers' opinion of the overall health of the economy, what's their attitude on business climate, about their personal finances, and their probability of spending in the future. So here in the circled portion, you can see that first, at the beginning of the pandemic, the sentiment has dipped significantly. And because of the vaccinations and things seeming like going back to normal, and that sentiment has started to climb up and reach a peak around April, that's around the second quarter. And then, but it starts to decline because of different factors. And most recently, the surge in the Delta variant has actually dipped the consumer sentiment a little bit. So I'm certain that like this number, when it's published next month, will start to go up, because these days the Delta variant cases are really have reached their peak. It's actually going down. Hospitality is also going down, and the school is also in-person school is also going forward. So most of the intermediate economic numbers that we look at are usually going in a very good direction. So this may go up, but it's very important to track the consumer sentiment and also the course of the pandemic, because it impacts the course of the economy. So it's very important to track that. But despite that, there are also other good signs. Which is very important for future loan growth. That's important for credit unions, which is the state of household finance, U.S. household finance. This graph shows you household debt as percentage of disposable income, which is published by the Federal Reserve. And as you can see, the household debt was at its peak during the Great Recession, obviously. And since then, it has been declining slowly. But what we see during this recession is a deep decline in the household debt. So that 1 month decline, this is data from mid of the year, is really huge when you compare it, when you compare the year-to-year variation. And this is really unprecedented, especially when you are actually in the middle of a recession. And when you merge this with the story that I just told you about how people were really good with debt, most of them were that we don't have non-performing loans. This is not in credit unions, but it's across the industry. That is actually a good sign. So it's not the overall size of the debt as a disposable income that is at its lowest, but the service obligation of households is also at its lowest, actually. So around the pre-pandemic level, people were using 9.8% of their income to service debt. That has declined significantly. So household finance looks at a very good condition. Of course, there could be heterogeneous impacts across different income groups, but overall situation looks very good. So with that, I would like to end my presentation. If you have any question, please welcome. Thank you.
Dawit, thank you so much. Very interesting. You know, it really speaks to the fact that I think we've seen the efforts to prop up the economy in the case of a financial crisis in the United States, at least, has worked. And it's really been a benefit to credit unions and credit union members. We can bring Franziska in now and answer some questions that folks have. And this one, though, I will not burden Franziska with this question because this is definitely one that is directed more towards Dawit. But Calvin asks, do you have an analysis of the changes and trends in the interest rate margins in residential mortgages?
Yeah, so that's actually one of the factors, not just in residential mortgages, but overall the interest rate margin is one of the risks that we have identified when it comes to future earnings for credit unions. So what we see is like that interest rate margin has been falling. And then we believe that could be also another downside risk in the future that's going to impact earnings for credit unions. So we probably are going to look that up, especially now that, you know, like the treasury bill is going up and, you know, there is a prospect of, you know, more interest rate change, especially in 2022. That's something that we need to look at and how that impacts credit unions. But broadly, we have identified that as one of the risks for earnings for credit unions in 2022. That's how much I can say about that.
Very good. And if anyone has questions, please use the Q&A button at the bottom of your screen and type them in there. And we have about a little more than 15 minutes left, so we have plenty of time to get to them as well. I do want to ask Franziska, and I don't know if this is something that the World Bank in your area of expertise has looked at, but obviously we can see from what Dawit presented was that many of the safeguards that were put in place during the financial crisis and then stimulus spending really helped both credit unions and their members stay above water this time compared to the great financial crisis. Are you seeing that around the world, that economies and governments that have put in those types of not only safeguards but spending measures did fare better during this period?
Yes, undoubtedly. But I was truly struck by the charts that David showed, how well the household sector in the US has done. And our sense is that other advanced economies have done equally well. This is a complete outlier in global recessions, and that's because of the stimulus that this time around was about tenfold what it was in 2009. So that explains some of it. It's an outlier not just compared to the history of past global recessions, it's also an outlier across countries. This is not what we see in emerging markets, developing economies, and it's an outlier across sectors. This is not what we see in corporate debt and government debt, at least in emerging markets and developing economies. That has soared. Emerging market and developing private debt, also plus corporate, is at levels that are the highest since we've got the data, since 1970, when our data series started. Private debt in emerging markets and developing economies, it's just out of the, beyond the historical record. And that's even if you exclude China, it's not just a China story. Government debt is the highest in emerging markets and developing economies since 1987, when a bunch of them went into debt crisis. Government debt in advanced economies is also at record high levels. So the household sector in advanced economies is really, your charts are striking that respect. It does seem to be the outlier, both over time and across countries and sectors.
Well, then if that's the case, then it seems like the pandemic has really laid bare the massive gap there between advanced economies and emerging markets and developing economies more than ever before, it sounds like. Because we've even seen that here in the United States, that while the aggregate, Dawit and I were just talking about this the other day, the aggregate health of credit union members is great. But when you look at some of the disparities between middle income and lower income, there's really a huge gap there. I don't know if that's a question, but I mean,
Yeah.
I guess you said that data bared that out here in the U.S., David.
Yeah. So so CUNA is working on a project which is called like financial well-being for all, because we want this overall health of household financial situation also to be beneficial for everybody. So of course there is inequality. So one of the impacts of this pandemic is, a lot of people are saying, it's like a K-shaped recovery. So some households are really growing fast, and you could see the stock market growing significantly higher during the pandemic. So 56% of US households have some interest in the financial market, be it directly or indirectly through their retirement plans. So they have seen their wealth go up. People who own houses, they have seen their housing value go up 19%, compared to pre-pandemic level. That's an increase in wealth. But on the other hand, people who do not have these things, that's the other dimension. So probably they could probably be left behind. But the direct payment to households is really significant, because that didn't exist in the previous stimulus programs in the financial sector during the 2007-2009, for example. So this direct assistance has been really beneficial, and also like the expanded childcare benefits. Those are like things that are also beneficial, probably not studied very well. So if you look at this data from the US Census, especially after the second stimulus payment, they have found like 60% of adults used money from the stimulus payment to pay down their debt. And that's why you see debt burden also declining. So yes, overall situation looks very good, but there are heterogeneous effects across different income groups or ethnic groups. But CUNA, that's a separate work that we are doing to highlight that, which is financial well-being for all, because credit unions would like to help everyone. It's people for people, helping people helping other people. So yeah, that's something that we emphasize.
Franziska, what are the dangers then? If we're seeing it here in the United States, and certainly you're seeing it in emerging and developing economies, emerging markets, developing economies. What is the danger for advanced economies if those emerging markets and developing economies are seeing this huge differential between what we're seeing here?
Yeah, so just one more add-on to what David was saying. What David was describing about within the US is definitely true across countries too. This is the lack of fiscal stimulus and monetary stimulus is one of the reasons why emerging markets, developing economies are lagging in their recovery. So in advanced economies, the average stimulus was in double digits, 10% of GDP. In emerging markets and developing economies, it was on the order of somewhere between 3 and 5% of GDP. That's one of the reasons why they're lagging behind. Now, what are the risks if something happens in emerging markets and developing economies? Are you asking what are the risks of spillbacks to advanced economies?
Sure. I mean, I have to imagine, we're all doing business all over the world with each other.
Yeah, so there has been a lot of research, and many people have looked for this spillback. It's very difficult to put a finger on it, to put a number on it. It's very difficult. So you can think of a lot of channels for spillbacks through the financial system, through declines in commodity demand. China, for example, is the largest source of metals and metals demand, and accounts for about a third of global energy demand. So you can think of channels why it should affect advanced economies. But it's difficult to put a number to this. If there is a crisis in, say, large emerging markets, this will reduce US growth by that much. So it's more about finding channels and who is exposed to these channels, who has exposures to financial systems in the large emerging markets, for example, that are most vulnerable.
We do have an audience question for you, Franziska. Someone asks, how long do you think the major developed economies will continue with quantitative easing, and what do you think would happen if they move to unwind that?
That's a really important question. What if there is some sort of monetary policy tightening in advanced economies. That has the potential to have a big impact on emerging markets and developing economies. And it doesn't even need to be actually unbound, as I said. It can just be the expectation. It's taper tantrum style, not just a reassessment by investors without any actual policy measures. That's the thing we're concerned about, that there is just an investor reassessment that suddenly raises borrowing costs for countries where debt is now at record highs and where foreign currency debt is a large share of government debt, at least. Now, on QE itself, in advanced economies, we expect that this will be very data-driven and it will take a while before they officially roll it back in a meaningful manner. But emerging markets have started to copy advanced economies last year. There was a number of them who implemented a QE last year of emerging markets, and about 1/3 of them have decided time to reverse course. So emerging markets are already beginning to roll back their quantitative easing that they put in place last year.
And do you expect that to be something that the Fed will consider here, Dawit? And if so, what would be the impact?
So the Fed already announced that they would start to, because there are two tests, because two goals for the Federal Reserve, right? It's maximum employment and stable prices. And according to the Fed, even though there are, short-term and medium-term, inflation expectations, in the long run, the inflation is going to stabilize because it's caused by imbalances in, demand and supply. The employment test, however, because we've seen like some slow in, especially the August employment report, we are actually waiting another report by the end of this week. But if both things are going in the right direction, the Fed has already indicated that they will start to slow down, not completely, but slow down the purchase of assets as soon as by the end of this year. But that doesn't mean the rates would go up. That probably could happen by mid-2022. Again, if things are going as expected. But again, so the taper tantrum, what they call the taper tantrum, like the Fed doing the slowing down and markets reacting, maybe more than that is needed. And then that could also, because that could also impact the economy. So that's a very delicate balance. But the Fed has already indicated economic conditions are really going in a positive direction, and it will start to slow down the purchase, but that doesn't mean rates would go up immediately.
Very good. Well, we are out of questions, and we're almost out of time here. So I want to thank you both so much, Franziska and Dawit. I mean, I think really anybody around the world got a lot of value out of both of your presentations to kind of see where we're headed, what some of the signposts are saying, and depending on where you are, it's a different story. But overall, even if you're in a good place, there's some caution to definitely take into account. So I do want to thank both of you today for joining me.
Thank you for having me.
It was a pleasure to join you. Thank you.
And thank you so much for joining us today, our attendees. Again, I do want to mention that today's webinar was recorded. It's going to be available later today on the World Council YouTube channel. That's at youtube.com/woku. We also want to mention that coming up in 2 weeks from today, on Thursday, October 21st at 9 a.m. U.S. Central Daylight Time, we will be hosting Building Financial Health for a Brighter Tomorrow. If we could see that screen so folks can get a better sense of when that will be. We will be hosting Building Financial Health for a Brighter Tomorrow, an International Credit Union Day virtual event. We're going to examine the current financial health of credit union members, and we'll also hear examples of credit union programs and initiatives around the world that have helped boost the financial health of credit union members. So you can head to woku.org/events to find more information on how to register for that event. Until then, thanks for joining us. Have a great rest of your day.